Hey everyone, welcome to a brand new episode of In the Money with Amber Kanwar. This episode with David Burrows of Barometer Capital was very interesting. He says that there is a big shift taking place in the market. It really has nothing to do with tariffs, but tariffs are making this trend happen faster. Listen to find out what those shifts are, and as usual, he gives his 3 best investing ideas. And as a reminder, if you want those pro picks right to your inbox as well as a daily market update, you can subscribe to our newsletter. Visit www.inthemoneypod.com and hit that subscribe button. Let's get into it. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and guests are their own and do not necessarily reflect the opinions of any organization or company. The host and the guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. This episode is sponsored by BMO InvestorLine. Investing can be intimidating, but it doesn't have to be. With BMO InvestorLine, you have the tools and resources you need to make informed decisions and build a successful portfolio. Their easy-to-use platform packed with research, tools, and commission-free trading on over 100 popular ETFs can help you take control of your financial future. Learn more at bmo.com/online investing. David Burrows, Barometer Capital, thank you so much for joining me.
I'm so happy to be here, Amber.
We have so much to talk about, but a lot of people are already familiar with who you are. I would love, though, just a little bit of a refresher and a primer on your investing approach, because it is unique.
Right. So we have a view, we take care of families primarily. And while everybody would like to think that an institutional pension manager is a great thing to get access to, our view is that a private client's expectations are more asymmetric. So they have full expectation their manager is going to get them exposure to the key themes in the market when it's good, but they really hate to lose money. So we think you have to be a little bit more tactical with private investors. Don't put them in a spot where they're down 20, having to decide if they can ride it out, because it turns out long-term investors, when they're down 20, actually find out they may not be long-term investors and they pull the plug. So we run a tactical strategy aimed at being more invested in better markets, identifying the areas of the market that are seeing net inflows and focus in those areas. But where we see breadth contracting, or the percentage securities performing well contracting, it causes us to get more cautious and we pull away.
You do a lot of fundamental analysis at your shop as well, and we'll get into that. But because that's your focus, you pay attention a lot to the health of the market.
Absolutely.
What are internals telling us? So now let's cut to today, where we are being whipsawed every day around tariff headlines. And on the surface, I guess we're 5% away from all-time highs from the S&P and the TSX. It's not great, but not awful. What's going on under the hood? What are the market internals telling you about how relatively strong the market is, or how relatively weak it's getting?
It's a great question, because everybody follows news flow. But just remember, there's 1,000 moving parts that impact prices. And the big obvious ones, the news, are part of it. But there's a lot of other things under the surface, and generally it takes a lot of them to move together to make change in the market, right? So we've been going through a pretty massive change in the market over the last couple of years, starting originally with the generational low in interest rates in 2020. Last time we had one of those was 1951. And we've gone from a world where basically the borrower was in control because of falling interest rates to a world where the lender is in control today. We're in a more inflationary environment, more persistent. And so things that are more benefited by inflation have slowly been taking the baton from the things that benefited for 40 years of falling interest rates.
So what's an example of that? Who's taking the baton and who are they taking it from?
Okay, well, there's certain things that do well in a more inflationary environment. For instance, where companies where price for their inputs go up today, they can raise their price tomorrow, right? So industrial companies. Banks are a big beneficiary of the world that we're in today, because there's actually quite a spread between the short-term rates and the long-term rates. They can make a spread. They do well in an inflationary environment. Some basic materials like gold. Gold went through a 10-year bear market. and about 3 years ago started to wake up. People still hate gold. But interestingly enough, the companies that produce it generate tons of cash. So companies that have an ability to generate lots of free cash, that are able to grow that without needing financing because the cost of money's gone up, those are the companies that are benefiting.
So let's talk about where tech fits into that, because tech has been the big winner since the pandemic. Even with rates rising outside of 2022, which was terrible for tech, tech has been such a strong performer. But now, 2025, here we're sitting and people are expressing their anxiety and tariffs by selling the tech and hiding in places like gold, hiding in staples, hiding in utilities. There is a real defensive instinct that's showing up in the markets.
Right, but you have to keep in mind, tech has been lagging the market since June of last year. That wasn't tariffs. And financials have been leading for the last 2 years. That's not tariffs. These things may be exacerbating the shift, but they're not causing the shift, right? There's a lot of other things driving this. So look, tech became owned by everybody. Forget the US, globally, right? We had a very strong US dollar and a very weak Japanese yen for years and weak euro. So a lot of those folks invested in the US because of the currency differential and because there was strength there. Now, the balance of power is shifting in currency land. Like Japanese yen is firming against every major currency. Last August, there was a big scare in the market because people said, well, they're going to unwind the carry trade, right? Japanese who had invested in the US because of their weak market and weak currency. Well, now their market's pretty good and their currency's pretty good. And actually, the Japanese yen versus the dollar is at the same level it was last August when we were all worried. And the carry trade is continuing to unwind, which means they wind up being natural sellers of the big US stocks. Global markets are way outperforming the US recently. And historically, when that starts, it goes on for years. So I think that there are some big shifts taking place and we have to be aware of them. Gold has outperformed the NASDAQ 100 for the last 3 years. That's a shift. That didn't happen from 2011 until 2021. 10 years, NASDAQ 100 outperformed. So things don't change all at once. There are slow, steady changes, and then they happen faster. So we're seeing a faster move. Semis have underperformed for 6 or 7 months. Everybody excited about AI, and AI's got a great future. But it may be that people are pretty fully loaded, and there may be some other opportunities from a risk-reward perspective.
So this is really important, what you're talking about. New leadership out of gold, outperformance of markets outside of the U.S., sectors like financials taking the baton from the tech sector. Importantly, you're not saying this is because of tariffs or anything. This shift was already underway. How long does this shift last? Do you think this is the new normal? It's a new cycle of outperformance?
So I'm big on understanding the long-term cycles. For instance, U.S. stocks went nowhere from 1966 to 1981. And in 1981, there was a very famous Business Week cover story saying the death of U.S. equities. And then, of course, they went up 18% a year for the next 19 years. And in 2000, things rolled over and they went nowhere for 13 years. During that period, global stocks did remarkably well. So since 2013, the U.S. has been the leader in the world. Global stocks went sideways. 3 years ago, they started to wake up really in earnest now. It's the same for commodities, underperformed for a decade. It just started over the last 3 years to show some relative performance. When these shifts take place, they go on for like a decade at a time. So this is not short-term stuff. Now, the things that are coming out of the U.S. administration are probably causing people to sit back in their chairs and say, wait a minute, I got to reassess. Do I really want my exposure there? What's going to get hurt and what's going to get helped? Hey, how come these financials in Europe have taken off like a rocket, right? Because they're looking, right? There's a reason to look because they're not feeling comfortable with the fact that their NVIDIA is down or Microsoft is significantly underperforming. So I think it's important as a manager to help identify these changes Because if people just want the market return, they'll go buy an ETF. If they want to be targeted in things where there's multiple expansion or revaluation, you have to recognize these changes, get positioned, and understand why they're happening.
So you don't think like the recovery and the rally in Europe, for example, is a head fake?
Not at all.
And what does this mean for Canada?
Well, interestingly, Canada behaves a lot more like global markets than U.S. markets. Canada, by the way, has outperformed the U.S. market since June of this past year, despite all the worry about tariffs. The reason is that the sector makeup of the Canadian market is more like global stocks. Global markets are dominated by financials. Over 30% of the MSCI All World ex-US Index is financials. They trade at about half the multiple of US financials, by the way. And then you have materials and energy and industrials, a lot of industrials. Warren Buffett's been buying Japan for the last 3 years. He's been buying industrials and the trading companies or financials. He's not a dumb guy. So the reason that Canada behaves more like global stocks is our sector makeups are a lot more like we have a lower tech weight. European countries have 1, 2, 3, 4% technology. The rest is, industrials and financials and consumer discretionary. So Canada's actually set up quite well. We think copper prices look pretty darn good. They're actually just in the process of breaking out higher. Energy's having some difficulty, but natural gas is pretty good. So Canada's set up pretty well.
So are you underweight tech? And talk to the investor who's just been so used to and so rewarded by dip buying in tech about why maybe it sounds like, if I'm listening to you, that strategy might not pan out.
Look, I'm not saying this is the same, but I started doing TV in the year 2000. So it's been 25 years. And I did it because my concern was that the secular bull market in tech stocks was run out of gas. And then it was going to get a lot harder. And people had been conditioned to buy and hold. Remember the old tagline, buy, hold, and prosper. So I spent the first 2 years talking about why people needed to have a selling strategy, some discipline around an exit. And in that next 3 years, of course, tech got crushed. Now, tech at that point was less profitable and probably a little bit more frothy, but it doesn't mean there can't be relative return changes. And so, I think today people need to understand where their line in the sand is. Because, for instance, the semiconductor sector regularly, even during this last 10 years, has 40% corrections. Right? It's down about 25% right now. It can easily go down 40 and still be in a longer term bull market. So I think you have to be willing to look outside of the biggest 7 stocks. We started about in March of last year at about 30% technology. By the end of March last year, we were about 23, 24. And slowly we worked our way down. We came into February of this year at about 6%.
Whoa,
I think
that's very underweight.
I think we're 3% today. And it's not because they aren't great companies. But who needs more of them right now than they have already? And when people start to get underwater, a lot of people came in. Right, retail investors came into tech hard in December and January of this year and are now all underwater. So there's a lot of money that can come out if people say, well, if I just get back to my break-even point, I'd exit.
So what does this mean? You say look for opportunities outside of the 7 stocks, which you're definitely doing in the portfolio. Does that mean you remain fully invested, or are you growing your cash position as well?
So breadth started to weaken in December. So breadth meaning if you took all the companies in the market and tracked them for which ones are in uptrends, the percent of stocks in uptrends has slowly been deteriorating in the US and somewhat in Canada. Globally, actually, it's fine. Actually, breadth has been improving. So when that happens, we stop making new investments in a market where breadth is contracting, and specifically sectors where things are contracting. So we have about 20% cash, not because we said, we're going to raise 20%.
Is that high? That's high.
That's high for us.
Yeah.
But, in 2001, I think we were 45% cash. We will go to over 50% cash in the certain types of markets like the financial crisis. But we use stop losses on our positions, meaning when we enter a position, we pick a price below the price we've entered, where if it crosses that line, we've used up our risk budget, we're going to the sidelines. As a position works out as we hope or expect, we constantly will ratchet the stop loss up in behind the share price, allowing for the fact that stocks pull back within an uptrend. So we're looking at logical points where the trend would change. So as a result, we've been stopped out of about 20% of our holdings in the portfolio, but frankly, the rest are acting pretty darn well.
All right. Well, let's go explore some of these other stocks that we should be thinking about. It's time to dip into the mailbag. Okay, our first question is on Metro, the grocery store company. Can I get David's thoughts on MRU and other grocers? Seems like a safe haven, but it doesn't seem clear what the impacts of tariffs will be. This one coming from Merrick on X. What do you think about Metro or the grocers in general?
Sure. So in that space, first of all, from a consumer perspective, we have almost nothing consumer discretionary. We think there are risks to the consumer in both Canada and the U.S. However, we do own Dollarama, and as a result, we're sort of in that staples area. So the grocers actually should do reasonably well. In the event of tariffs, frankly, what we've learned about grocers is that when their costs go up, their prices go up a bit more. So realistically, they're making a margin on their revenue, and if there are tariffs and their prices go up, then they're probably going to take a little bit more on the way through. So actually, Metro's been behaving very well in this market. It's been rock solid, frankly. You wouldn't know there were tariffs or something else going on. Now, this is a defensive security, a lot like Loblaws is defensive, grocery and pharma. It probably is more defensive than a Dollarama, which is more a growth stock. But, pays a nice dividend, and the dividend will steadily grow. It's not certainly aggressive, but it's certainly not going to hurt you.
So how much do you think these stocks like the Dollarama, the grocers will benefit, maybe operationally, because people are they're going to the dollar store more often because they feel their wallet is being crimped, but also just from flow of funds, because investors are looking for these safer places to hide. Could that be supportive of the stock? Could that make them more expensive?
Yeah. So keep in mind, there are a lot of portfolio managers whose job is to be fully invested all the time, right? So if a pension fund picks an equity manager, they're making the decision to be in stocks. They expect that manager to stay fully invested, which is why we're not in the pension business. But if they're concerned about risk, they may take some from things that are a little more economically sensitive and move to things that are less economically sensitive. So defensive stocks like staples and utilities have underperformed for the last 3 years badly, of course, because the bond market was weak also. And they have had more of a bid over the last few weeks because there is a kind of a growth scare going on. And as a result, staples are behaving a little better and the defensive equities are performing better. Just keep in mind, if things start to clear, they will likely underperform.
They will start to
So it's not impossible that this tariff issue is not going to last a long time. And I've got some insight on that, I think. In that case, it's not going to be these that lead the market. They'll be fine, and you'll get your dividend and some dividend growth. But I don't think this is going to be leadership. You
talked a lot about a market shifting to these new forms of leadership. Does that then undo? Because if tariffs all of a sudden aren't a big problem, like how nimble do you have to be in that thesis?
Okay, so I'll bore you for a minute. The last time we had a generational low in interest rates was 1950. Interest rates were 1.6% after the Second World War and the Depression and so on. Our governments held interest rates artificially low because they couldn't afford to pay the debt that came out of the war. When people started to consume after the war, there was some inflation, rates started to rise. And from 1951 to 66, rates went from 1.6 to like 7%. During that period, the stock market went up 15% a year. So the idea that stocks can't go up if rates are going higher is just false. During that period, the greatest source of growth in the market was dividend growth stocks. They became known as the Nifty 50. And they traded at almost 100 times earnings by the end of it. So what worked through that period were companies that generated tons of cash. It didn't matter what rates did because they didn't need financing. I think that's where we are today. I think we are more likely to see persistent inflation in fits and starts. Probably in the absence of anything else, this is where inflation would start to tick higher again. After a first wave, you tend to have a moderation, and then a second wave. And so the things that act like bonds are unlikely to lead, because if bonds are hurt by a little more inflation or higher rates, things that are high dividend payers with no growth also are hurt. So I don't think they will be leadership. I'd prefer to see companies that are really growing their cash flow. Banks fit that mold. Banks' earnings were up 14% in the last quarter, and they represented the highest percent of earnings in the S&P they have had in years. And Europe is similar. Revisions to estimates are going higher for banks everywhere.
All right, and we're going to talk about financials and pro picks because you've got one as your top idea. Our second question is about Starbucks, and this is an interesting one because you said you're cautious on the consumer. I don't know if they're going out and spending $8 on a latte, but there's also a bit of a turnaround for Starbucks in Brian Niccol. So this question is thoughts on Starbucks. Brian Niccol is making positive changes so far, seems to be laser focused on operations. Can he pull it off? This one coming from Learn to Invest Kid on X.
Yeah. So let's start with backdrop. 70% of return comes from market backdrop. Are stocks okay? And is the sector okay? So I think you have a headwind from the sector. If you look at companies like McDonald's, Nike, other consumer branded companies, they're having a harder time. But Starbucks is a big ship, and it is going through a turnaround. Reducing the size of the menu has been useful. He's making a lot of operational changes, so that's great. Now remember, the stock's just come from 70 to 110, so it's come a long way. I would probably not chase it up here. I would give it some time to maybe consolidate a bit. But, you know, it's one certainly worth watching. It's hard to turn companies around, but it's a great brand and it's a really good company. I would just say it's probably a little extended here.
Our next question, I'm sticking with consumer, is about Canada Goose. And the question is, can it go back to being a growth stock again? This one coming from Mark in the inbox.
Yeah, so there's an old saying, there's a long way that a stock needs to drop when it goes from being a momentum stock to a value stock. This stock has been a serial underperformer since 2019. The one thing I always say is we do not try to pick bottoms ever. We want to own companies that are good to begin with, but we can see are getting better. And this would surely be a turnaround. I would stay clear. Tough sector. Apparel is not doing well, and they're not doing well in the apparel sector. Just think of it this way. Anybody who bought it from $100 on the way down here to $14 is just waiting for their purchase price to get their money out. You've got all these built-in sellers. I would stay away.
Okay, let's squeeze in one question here before we have to go to break. This one is on TMX Group. What is the thesis around TMX Group these days? It owns Toronto Stock Exchange, but what have all the recent acquisitions done to transform the company? And this one has just been a relentless mover to the upside, I think trading at an all-time high after a couple of years of not really doing anything.
This has been a top 10 position at Barometer for the last 18 months. And
Good for you. It's done well.
Used it as public picks a number of times. First of all, the exchanges in general are doing well. Remember that we've moved into a data-driven world. All they are is data. Trading volumes have been decent. Mergers and acquisitions and financings are accelerating, and that's positive. But in their acquisitions, they've got a very interesting commodity trading platform that is really gathering steam. So there's a lot of things that drive this. I like to reverse engineer it and say, do we really think the market's going off a cliff when the exchange companies are trading at all-time highs? That's a market tell. If we really thought the market was in trouble, TMX Group would not be trading at new highs. When we've watched, Goldman Sachs. Goldman Sachs has been a leader over the last couple of years. Again, that's a market tell. So I like TMX. It's a growth stock, so it would be vulnerable if it missed an earnings report, like all growth stocks. But they really are executing, and we like it and own it.
This one is one that the sell side has just totally missed. They were so reluctant to upgrade the stock, even as it went all-time high, all-time high. Now there's 2 buys on it, but I remember when it was going through record highs and just 0 buys. And I don't know, how do you think about that? Because normally sell side loves to put buys on stocks, but they were so restrained on TMX Group.
Remember that the sell side is a younger demographic who maybe haven't seen, for instance, a commodity cycle. When you've had a 10-year cycle of commodities being poor returners, looking at a commodity trading platform that they're building might not be very interesting. Now, my view is we are in the very early stages of a much longer-term upcycle in commodity prices. And I think that people maybe will slowly wake up to that. But I think that TMX Group is likely to see lots of financings. There have been no financings in Canada over the last few years. And we think that trading volumes can move higher. So we like this one. It's obviously a little bit stretched, and it certainly could pull back, but it's had a series of higher highs and higher lows. So technically very sound, fundamentally sound. And it's in a sector that has a big tailwind.
All right, let's take a quick break here. For over 25 years, Raymond James has been helping Canadians achieve their financial goals. They are Canada's largest independent financial services firm with over 520 dedicated advisors, $88 billion in assets under management, and capital market services. With no proprietary product to push, their advisors are free to focus on the unique needs of their clients. Whether you're saving for your children's education, preparing for retirement, or safeguarding wealth for future generations, Raymond James is committed to guiding you every step of the way. Visit raymondjames.ca today to discover how you can live a life well planned. Okay, we're back. You've heard David talk about commodities, and so the next couple of questions are about companies with exposure to that story. The first one here is about your outlook for Ivanhoe mines and copper demand in general, which you've hinted that you're getting more positive on. Copper is recyclable, and is this factored into the demand analysis? In other interviews, David has mentioned that he was bullish on Ivanhoe.
Yeah, we are bullish on copper. This is very economically sensitive, so it pulled back a little in December. If you look at copper prices today, they're headed out through the highs, and we think technically really well set up. Every company is treated differently. Ivanhoe has a little bit more geopolitical risk, so it would be a little bit more volatile than some other securities.
What's your preferred play then in copper?
Well, look, on the senior side, I would buy Tech B all day long. Early stage for their QB2 mine, which has just been really coming into sort of full production. They've had some production difficulties getting going, but they'll work through that. Geopolitically, great location. I think that Hudbay is interesting. And on the smaller side, Foran Mining, FOM, in Canada, that is probably one of the most interesting earlier stage companies that you can take a look at. Look, if you think that the economy isn't going off a cliff, we need copper. You need copper for so many things.
Doesn't that feel like a big if?
Well, I don't think that the economy is going off a cliff. And remember, there's a ton of copper gets used in munitions, and that isn't recycled.
And
Europe is about to arm up, and that will be a driver for copper prices. We do need more energy for AI for sure, so I think that you shouldn't not look at this group. I think it's interesting. I wouldn't pick Ivanhoe as my number one. I've talked about Hudbay before. I've talked about Tech B. Both of them, I think, are at low ebbs. I think they'd be a good entry point here.
And the third one you mentioned for our viewers, Foran Mining, which is ticker FOM,
yes,
as in Mary on the TSX. Our second commodity question here is about Alamos Gold. Do you still like it? And what are your expectations for the stock in 2025? We've talked about this strengthened gold bullion. Yeah. does this work for Alamos?
So these have been unpopular choices. They're more popular now because they've had a great year. We have a lot of gold exposure. A lot for us. We are not gold bugs, period. We went probably a decade without owning a gold stock, but we own quite a lot now. So Alamos is interesting because it is a growth producer. They have lots of opportunity to continue to grow their reserves. Their costs are in check. They've operated really, really well, and it's early stage. I do think along the way we're going to see some mergers and acquisitions, and some of these more intermediate players could be targets. But Alamos broke out going back to March of 22, so it's now been 3 years. And it's been marching its way higher. I think that it's a great growth producer.
So it's all-time highs, but you would still feel comfortable adding here?
So let me give some context. If you looked at the GDX, which is the gold ETF, gold producers ETF, if you look at what happened in previous bull markets, just take gold stocks. You take Agnico. In the last bull market between 2001 and 2011, there was 3 distinct waves higher, and each wave went to like 160, 170% above the long-term moving average. Right now, it's about 80% above. Alamos.
Okay.
If you look at gold itself, gold tended to have 3 waves higher. Forget the one in the 70s and 80s. That was even bigger. But, gold got to like 85% above the long-term moving average. It's about 40% today. I think that we're in the early stage of the first leg of a bull market.
For gold. Now, how do we reconcile that with the lagging that we're seeing in a Newmont, in a Barrick? Are those names that you own, or do you not like them because they're relative underperformers?
The very senior companies have had a very difficult time growing and operating. And so we don't have any exposure. We have exposure to Agnico, Kinross, Wheaton Precious Metals, and Alamos are their 4 key positions. They are dividend payers, dividend growers, generating tons of cash. If you look at the differential between current gold price and the performance of the stocks, the cash flow that they're producing, they're trading at almost record low cash flow multiples. So we're not looking at these as speculative investments. These are cash generators and dividend payers and dividend growers. We also own Franco-Nevada. I forgot that. So look, there's something for everybody. AGI is a growth producer, right? Alamos, Wheaton Precious Metals, a great dividend growth stock. And Agnico is both. They've been paying a dividend for 40 years. They've got 11 mines, well diversified, great operators, generating a boatload of cash. And if the price of gold continues to move higher, which my guess is it is likely to do, then the cash flow is going to continue to grow. And private investors are not in this group right now.
So there's still some flows that could come into the sector. On dividends, this is our next question. Does Mr. Burrows see any high dividend paying stocks with at least the rate of inflation increasing? Does he prefer stocks with a dividend plus potential share appreciation, or no dividend and potential gain on the stock price? This one coming from Shane on X. And I feel like you've touched on this, but maybe let's just really drive the point home. So how do you think about dividends?
Forget about this climate. Let's talk overall over a very long period of time. If you broke the TSX up into 5 cohorts, non-dividend paying stocks, very poor returns over time. High dividend payers, better. Dividend growers, the best. Dividend cutters, the worst. Okay. So dividend growers over time have had the same or slightly better return than the TSX index. This is since 1986, with 2/3 of the volatility of the stock market. So less risk at or ahead. If we look at the world of stocks in the period of rising rates from 1951 to 1981, dividend growth stocks crushed the market returns with a lot less risk. I think that's the environment that we're in today. So I'd far rather have a lower dividend and a lower dividend payout ratio, right? The percent of earnings they're paying out, but one that has consistently grown, than a high dividend that doesn't grow.
And that way you're not overly indexed to like utilities or telcos
Right.
where you're still getting income.
Right. So for instance, some of the big financials fit that bill. And that's really interesting to us.
Charles Dow asked on Twitter, I would love an opinion on Bank of New York Mellon. I'm enjoying the show. Thank you for providing the opinions. How does this fit into your view around financials, around dividend growth?
Yeah. So Bank of New York is certainly a dividend payer. Their dividend growth has been relatively low, right? But it does fit with what's happening with the banks. I would prefer a JPMorgan. I want to own the leader, right? They have the best employees. They have the most money to spend on their improving the business. Their spend on technology is off the charts. This is the greatest, I think, example of buying a leader. The XLF, which is the ETF that holds financials, went nowhere from 2007 to 2021, did not make a new high. That's a secular bear market. It eventually did make a new high in 2021. JPMorgan made a new all-time high in 2013 and has been making new all-time highs since. They've raised their dividend twice in the last 12 months, right? This is the best run, best balance sheet, best global reach. Why wouldn't you want to buy a company with all those advantages? So that would be a big holding for us and a great dividend grower that will give you dividend, a rising stream of income to offset a rising cost of living, and share appreciation because it's in the right group and multiples are expanding.
All right. Well, that leads us perfectly into Pro Picks. Pro Picks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, so you were already talking about this, JPMorgan, and any wonder it is your first pro pick. So you said that you liked it for dividend growth, relative outperformance. I guess the question is, how do you think about how much further it can rally from here?
Right. So I always take the lens back, right? I'm a big proponent of looking at long-term price charts. And when a sector has underperformed for a decade and starts to perform, or 15 years in the case of financials, that's the beginning of something. And it doesn't mean it's going straight higher, but it probably means you have a decade in front of you of strong returns. When I pair that with the shift in interest rates that happened in 2020, again, there's going to be rates will move higher in fits and starts, but they likely move higher for the next 10 to 15 years. And so if you think about it, the biggest winner in that world is that the power is in the hands of the lender to get paid for lending money and to being in the center of monetary transactions. So yes, it's been a great performer, but you think about what happened to NVIDIA in the 10 years that tech was leading, or what happened to Cisco in the 10 years up to 2000. The leader continues to lead. So portfolio managers are human too. They have people they report to. They want to own quality in their portfolios. Nobody's ever getting fired for owning JPMorgan, right? So I think they are going to continue to be a leader with or without Jamie Dimon. They've got an incredible franchise, and it's very hard to beat. Every time another bank gets into trouble, they get shepherded into JPMorgan's hands and they make more money.
So JPMorgan is down about 10% from its most recent all-time high. And you said part of your discipline is you've got stop losses that mean you would roll out of the stock because it's hit that target. So we've pulled back 10%. At what level would you come out?
Right. So we're big believers in wanting to see the securities that we own make higher highs and higher lows. And if you take a look at JPMorgan's share price since the market turned in August, it actually put a low in before the market did in October of 22. It's made nothing but higher highs and higher lows. So I think that if the stock was to trade kind of below 236.
It's 250 right now.
Yeah, we would probably be going to the sidelines. You have to keep in mind that every stock has its own personality. I use point and figure price charts to help understand change points where something goes from making higher highs and higher lows to lower lows and lower highs, uptrend versus downtrend. I want to own a stock as long as it's been in an uptrend and that it continues to be good, getting better, where the financials continue to support our view, the technicals support our view. We like to have the sector wind at our back. All of these things are in line here on JPMorgan.
Okay, so let's see how that applies to your second pick, which is Fairfax Financial, also a stock that has just run so massively, making new all-time highs after all-time highs. What are the catalysts you think here?
So look, when you buy a property and casualty company, you're buying an investment portfolio, right? Like the reason people buy Berkshire Hathaway is because they've done a marvelous job taking the float and investing it and generating a return in excess of what they have to pay out to their claimants. And Fairfax is the same. It's just a lot smaller, right? Prem Watsa has done an amazing job in building out his firm, and they've made great investments. The percent of their return that comes from dividends and interest continues to grow, which is very safe, right? Their return on private company investments have been pretty good. But as a business, it's growing more quickly than all of their cohorts. There are about 10 big companies in property and casualty. This company is growing faster than all of them and trades at a discounted price to almost all of them. So we're paying.
Even though it's at an all-time high, let's underline that. You still say it's trading at a discount.
Their investment returns are great. Their growth in writing policies is great. The payout ratio is pretty good. And the thing about property and casualty is when there's a bunch of disasters like there were last year, it means that the insurance companies have a sort of a license to harden their prices, which means they raise the price of your auto insurance, right? We don't like that. I would like to own Fairfax and offset the increasing cost of my auto insurance, especially for my kids. So look, Fairfax has been a great performer now.
And I think people call Watsa sort of the Warren Buffett of Canada, and the stock's actually done better than Berkshire.
It has. So we've owned this stock twice. This is the second time, and it's been our top holding for about 18 months. The first time we owned it was when my ex-partner joined the firm. We owned the stock from $16 to $600. These companies, when they get going, can go a long way.
$16 to $600. So when did you own Fairfax this second time? This is in
the way back. So we've owned it for about the last 2 years.
2 years. Okay. So you've seen a nice run, more than a doubling.
Yeah. But look, it continues to execute. And the financials are a tailwind sector.
You've talked about your holdings in gold, and Agnico is one of those holdings that you have. It has been, on a relative basis, outperforming some of those others senior producers out there. Why do you continue to like Agnico?
Look, this is a company, if you were going to own one gold stock, this is probably the one you would buy. If you think about it, they are geographically diversified. They have 11 different mines, so they're not dependent on one. A single mine company can do very well, but you can lose a lot of money. They have a long history of execution. Being an operator in this industry is really hard, right? Because it's variable conditions when you're mining, and being able to operate consistently is not common. It's a company that pays a dividend and has for 40 years. It's a company that's growing its cash flow quite dramatically, and it's an institutional favorite because this is a relatively large cap company at a $70 billion market cap, and it can go into any portfolio, and it's liquid. So I think that this is a company that somebody could have a 3, 4, 5% weight in their portfolio and cover off gold. I would probably own a little bit of physical gold as well. And again, we're not gold bugs, but there's a time and a place, and this is probably in the sweet spot. So
already close to all-time highs. So is gold. How much more could it go? Does it need to see bullion prices continue to advance?
Yeah, so that's a great question. So keep in mind that a lot of the bullion advance has not been investors. It's been central banks.
Yep.
There's that old line, don't fight City Hall or don't fight the Fed. Like central banks around the world are buying gold. And so we have to keep that in mind. Retail investors have really only just engaged. In the last 2 weeks, there have been fairly sizable flows into gold itself through ETFs. And the producers have really underperformed up to this point because everybody knows you'd be an idiot to buy a gold stock. Well, I understand that because, we went through a bear market from 2011 to 2021. Nobody made money, so why would you put money there? It takes time for people to catch on. And when this stuff starts, if you've looked at cycles over time, it might happen 2 or 3 times in the course of your life. There's an opportunity here. So look, it's about 80% above the long-term moving average. If you go back to the last bull market, it regularly, 3 legs higher, got stretched 150% above the long-term moving average. So you could see the stock go up a bunch from here and be just similar to other previous gold bull markets.
All right. Fascinating stuff. Thank you so much, David Burrows. I think we help people make some money in this episode.
I really appreciate you having me, Amber, and I think your new program is great.
Thank you so much. That's David Burrows of Barometer Capital. Make sure you join us for the next episode. We've got Jordan McNamee. He's the president and CIO of the Optimus Fund. He talks about growth stocks. You can submit your questions to questions@inthemoneypod.com or anywhere on social media. We're at In the Money Pod. We'll see you on the next episode.